Get ready, because the crypto world is absolutely buzzing today. We're diving headfirst into a whirlwind of market-shaking news that you absolutely cannot afford to miss. From massive shifts in investor sentiment to bold predictions that are turning heads, this is the adrenaline shot your crypto knowledge needs. The pace is relentless, the stakes are high, and we've got the inside scoop on everything that matters. Strap in, because you're about to get the unmissable updates that are defining the future of finance, right here, right now. First up, we're tracking a significant financial movement that's sending ripples through the market. Imagine nearly $300 million being pulled from major digital asset funds. What's behind this massive shift, and how is it connected to the latest economic indicators and even global trade policies? We've got the breakdown on who's moving what and why it matters to every investor. Then, we're getting a dose of incredible optimism from a prominent figure in the business and political world. He's doubling down on an astonishing prediction for a certain digital currency, calling for it to reach a staggering $1 million. What's fueling this sky-high confidence, and what does it mean for the broader adoption and future value of this asset? We're exploring the conviction behind this bold forecast. And finally, we're tackling the age-old debate, gold versus Bitcoin. With a major political shift potentially favoring digital assets, is it time to rethink your traditional safe havens? We're analyzing the distinct roles each plays in diversifying risk and how current economic trends are influencing this critical investment decision. Don't miss out on these crucial insights. Hit that subscribe button, ring the notification bell, and join the Bitcoin Bulletin community. Market turmoil. Billions exit major digital asset funds amidst inflation fears. Investors are yanking nearly $300 million from Bitcoin and Ethereum exchange-traded funds, a significant capital flight triggered by a surprising surge in U.S. inflation data. This dramatic outflow, particularly on a Friday following the release of the Core Personal Consumption Expenditures (PCE) index, has sent shockwaves through the crypto ETF market. The PCE index, the Federal Reserve's preferred inflation gauge, showed a 2.9% year-over-year increase in July, marking the highest level since February 2025. While this figure met expectations, the underlying inflationary pressures, especially in core categories, are a cause for concern, suggesting persistent price increases despite efforts to stabilize the economy. Analysts are pointing fingers at the current administration's trade policies, specifically the 10% baseline tariff on all imports and additional duties on specific goods. These tariffs are reportedly increasing the cost of imported goods and materials, directly contributing to the observed rise in consumer prices, even as gasoline prices have fallen. The increase in service prices, up 3.6% year-over-year, further indicates robust demand in key sectors like housing, healthcare, and transportation, signaling that inflationary pressures are embedding themselves in the economy. This economic backdrop is creating uncertainty about the Federal Reserve's next moves regarding interest rates. While markets are still pricing in potential rate cuts, the persistent inflation spurt could delay or alter the timing of such easing. A weakening employment market might tilt the scales toward monetary easing, offering temporary relief to risk assets like cryptocurrencies. For Ethereum ETFs, the situation is particularly notable. After 5 consecutive days of substantial inflows totaling over $1.5 billion, Friday saw a stark reversal, with $164.64 million exiting the market. This outflow not only erased recent gains, but also highlighted Ethereum's perceived higher risk profile during times of macroeconomic uncertainty. Despite this short-term turbulence, Ethereum's underlying fundamentals remain strong, with corporate treasuries holding over 4.4 million ETH, valued at more than $19 billion. Experts like Fabian Dorey from Sygnum Bank acknowledge Ethereum's recent revival, citing its adoption rate and diverse use cases as key strengths. However, the Friday outflows underscore the market's sensitivity to broader macroeconomic shifts and policy decisions. But what happens when optimistic predictions clash with market realities? Next, we're hearing from a prominent voice making an extraordinary claim about Bitcoin's future price. Eric Trump predicts $1 million Bitcoin, a bold forecast amidst market volatility. Eric Trump, a co-founder of American Bitcoin, ABTC, and son of U.S. President Donald Trump, has reiterated his strong conviction in Bitcoin's future, boldly predicting that the cryptocurrency will reach the $1 million mark within the coming years. Speaking at the Bitcoin 2025 Asia Conference in Hong Kong, Trump cited the escalating demand from governments, major corporations, and affluent families as the primary drivers for his ultra-bullish outlook. "Everybody wants Bitcoin. Everybody is buying Bitcoin," he stated, reinforcing his long-held belief that Bitcoin's trajectory is undeniably upward. This $1 million prediction is not new for Trump. He made a similar forecast in December 2024. This time, however, he emphasized that institutional adoption is still in its nascent stages, and current holders are essentially still early adopters. He noted that a significant portion of the global population has yet to grasp the transformative potential of digital finance. Trump's comments coincide with a period of increasing momentum for ABTC, the mining firm he co-founded. In August, Griffin Digital Mining shareholders approved a reverse merger with ABTC, a move that will see the combined entity trade under the ABTC ticker on Nasdaq starting in September. This strategic merger, initially announced in May, allows American Bitcoin, established by Donald Trump Jr., and Eric Trump to access public markets via Griffin's existing Nasdaq listing, bypassing a traditional IPO. Following the merger announcement, Griffin's stock experienced a remarkable surge, climbing over 230%, including a significant 42% jump on the Thursday preceding the listing. The company is now widely viewed as a direct beneficiary of the Trump family's growing influence within the digital asset sector. American Bitcoin has strategically positioned itself as a pure-play Bitcoin mining venture focused on accumulating the cryptocurrency. The company has publicly reported holding 215 BTC, though external data suggests its reserves could be substantially higher, potentially approaching 1,941 BTC. Despite this bullish sentiment, Bitcoin has recently experienced short-term price weakness, declining nearly 13% from its all-time high of $124,500 recorded on August 14. The asset is currently trading below its 50-day exponential moving average, a critical technical indicator closely watched by traders. This optimistic prediction from Eric Trump stands in contrast to some market analyses. Galaxy Digital CEO Mike Novogratz, for instance, has cautioned against near-term $1 million Bitcoin price predictions, suggesting such a scenario would likely stem from a U.S. economic collapse rather than a pure crypto success. Novogratz expressed a preference for a lower Bitcoin price within a stable U.S. economy. He elaborated that severe currency devaluation often drives demand for alternative safe haven assets, positioning Bitcoin as a hedge against economic instability, but at the potential cost of societal well-being. Furthermore, Glassnode lead analyst James Check has raised concerns about the long-term viability of corporate Bitcoin treasury strategies, implying that the easy gains for new entrants may be diminishing as the market matures. These sentiments echo recent warnings from Matthew Sigel, head of digital asset research at Van Eck, regarding the treasury strategies employed by publicly traded firms. While some are looking to the future of digital assets, others are reevaluating the classic safe havens. Next, we're diving into the classic debate: gold versus Bitcoin in 2025. Bitcoin and gold in 2025, diversifying risk with dual hedges. As we look ahead to 2025, the conversation around diversifying investment portfolios to hedge against risk is intensifying, with a particular focus on the roles of Bitcoin and gold. Traditionally, gold has been the undisputed safe haven asset, lauded for its stability and historical performance during economic downturns. However, the emergence of Bitcoin as a digital store of value has introduced a new dynamic, prompting a reevaluation of how these two assets function within a diversified strategy. Andrei Dragosh, European head of research at Bitwise Asset Management, offers a nuanced perspective, suggesting that gold and Bitcoin serve distinct purposes in hedging against different types of market stress. His analysis indicates that gold continues to be the superior hedge against stock market losses. Decades of market data support this, showing gold's low or even negative correlation with major equity indices like the S&P 500. For instance, during the 2022 bear market, while the S&P 500 experienced a nearly 20% decline, gold prices saw a modest increase of about 5%. This resilience solidifies gold's status as a classic safe haven. Bitcoin, on the other hand, has shown a more complex relationship with market volatility. While it has historically struggled during equity panics, famously collapsing over 60% alongside tech stocks in 2022, its correlation with U.S. Treasuries presents a different picture. Studies suggest that Bitcoin has often demonstrated a low or slightly negative correlation with government bonds. This means that during periods when bond prices fall and yields rise, as seen in 2023 amid concerns over U.S. debt and deficits, Bitcoin has sometimes outperformed gold. Dragosh's practical takeaway for investors is that the choice is not necessarily an either-or situation. Instead, holding both assets can offer a more robust diversification strategy. Gold excels when stocks are in decline, providing a buffer against equity market downturns. Bitcoin, conversely, may offer protection when the bond market is under pressure due to rising interest rates or fiscal concerns. This divergence has been evident in the performance of both assets year-to-date as of August 31. Gold prices have surged over 30%, driven by renewed demand amidst equity volatility linked to tariffs, slowing growth, and geopolitical risks. Bitcoin, while also performing well with a gain of approximately 16.46%, has shown a different pattern, correlating more closely with shifts in U.S. Treasury yields, which have fallen around 7.33% over the same period. The S&P 500, in comparison, has seen a more modest gain of roughly 10%. This differing performance reinforces Dragosh's heuristic. Gold thrives on equity jitters, while Bitcoin holds its ground when bond markets face pressure. This view is echoed by a Bitwise research report, which also concluded that gold is a reliable hedge against stock market downturns, whereas Bitcoin tends to offer stronger returns during market recoveries and exhibits a lower correlation with U.S. Treasuries, suggesting that combining both assets can optimize diversification and risk-adjusted returns. However, it's crucial to acknowledge that correlations are not static. The increasing inflows into Bitcoin spot ETFs in 2025 have integrated BTC more deeply into mainstream financial markets, potentially altering its behavior as a bond hedge. Short-term shocks, such as regulatory surprises or macroeconomic events, can also cause both gold and Bitcoin to move in tandem, momentarily diminishing their hedging effectiveness. Therefore, Dragosh's rule of thumb should be viewed as a guiding principle rather than an absolute guarantee. Ultimately, the question of whether to abandon gold for Bitcoin, especially given the current administration's pro-crypto stance, is met with a data-driven no. The key lies in recognizing that gold and Bitcoin hedge different risks, and a dual-asset strategy might be the most prudent approach for investors navigating the complexities of 2025. But with shifting political winds and evolving market dynamics, could one digital asset truly replace a time-tested hedge? Next, we're examining the case for Bitcoin over gold in the current climate. Trump's pro-crypto stance: is gold's reign as the ultimate hedge ending? The current administration's vocal and consistent support for cryptocurrencies has ignited a significant debate among investors. Is it time to pivot away from gold, the traditional safe haven asset, and embrace Bitcoin as the primary hedge against economic uncertainty? This question gains traction as digital assets become increasingly integrated into mainstream financial strategies. Andrei Dragosh, European head of research at Bitwise Asset Management, offers a compelling perspective that suggests the dichotomy is not so clear-cut. He proposes a practical rule of thumb: gold remains the superior hedge against stock market downturns, while Bitcoin is increasingly effective as a counterweight to stress in the bond market. This distinction is rooted in historical market behavior. For decades, investors have turned to gold during periods of equity market turmoil, a trend supported by consistent data showing gold's low, and often negative, correlation with the S&P 500. When equities tumble, gold typically holds its value or even appreciates, as evidenced by its performance during the 2022 bear market, where it rose approximately 5%, while the S&P 500 plummeted nearly 20%. This pattern solidifies gold's long-standing reputation as a classic safe haven. Bitcoin's behavior, however, presents a different narrative. While it has historically faltered during equity panics, experiencing a significant collapse alongside tech stocks in 2022, its relationship with U.S. Treasuries has been more encouraging. Several studies highlight Bitcoin's low or even slightly negative correlation with government bonds. This implies that when bond prices decline and yields rise, a scenario that occurred in 2023 due to concerns over U.S. debt and deficits, Bitcoin has shown resilience, sometimes performing better than gold. Dragosh's analysis leads to the conclusion that investors need not choose between gold and Bitcoin. Rather, they serve complementary roles in a diversified portfolio. Gold acts as a bulwark against stock market volatility, whereas Bitcoin offers potential shelter when bond markets are stressed by rising rates or fiscal anxieties. The performance data from the current year, as of August 31, supports this thesis. Gold has seen a remarkable year-to-date gain of over 30%, largely driven by increased demand during periods of equity volatility influenced by tariffs, economic slowdowns, and political uncertainties. Bitcoin, while also posting a solid performance of approximately 16.46%, has moved differently, with its trajectory showing a notable inverse relationship to the roughly 7.33% fall in 10-year U.S. Treasury yields. The S&P 500, for context, has gained around 10% in the same period. This divergence underscores Dragosh's point. Gold benefits from equity jitters, while Bitcoin holds its ground amidst bond market wobbles driven by higher yields and substantial government borrowing. This perspective is further validated by a Bitwise research report, which similarly concluded that gold is a dependable hedge against stock market downturns, while Bitcoin tends to yield stronger returns during market recoveries and exhibits a lower correlation with U.S. Treasuries. The report advocates for holding both assets to enhance diversification and optimize risk-adjusted returns. It is important to note that these correlations are dynamic. The substantial inflows into spot Bitcoin ETFs this year have integrated BTC more closely with traditional risk assets, potentially diluting its effectiveness as a pure bond hedge. Moreover, unforeseen events like regulatory shifts or liquidity crises can cause both gold and Bitcoin to move in unison, temporarily undermining their hedging capabilities. Thus, Dragosh's heuristic serves as a valuable guide, not an infallible rule. Considering the current administration's pro-crypto stance, the question of abandoning gold for Bitcoin is a provocative one. However, based on extensive data, the answer leans towards a balanced approach. Gold continues to be the preferred hedge for stock market volatility, while Bitcoin may provide a hedge against bond market pressures. The prudent strategy for investors is not to discard one asset for the other, but to recognize their distinct hedging roles and leverage, both for optimal portfolio diversification and risk management. These distinct roles highlight the evolving landscape of hedges in uncertain times. Now, let's recap the day's most critical financial updates. And that's a wrap on today's Market Pulse. We saw major outflows from Bitcoin and Ethereum ETFs amid inflation spikes. Eric Trump doubled down on his $1 million Bitcoin prediction, and we broke down the gold versus Bitcoin hedging debate. Don't miss out on any of the action. Smash that like button, subscribe to Bitcoin Bulletin for more critical updates, hit the notification bell so you never miss a video, and follow us on all social platforms to stay connected. We'll see you in the next one.